be on Facebook too. There we go. All right. So we are officially live. So just in case you're curious, because Chris just asked me this question, we're live on Instagram, we're live on Facebook, and we're live on YouTube all at the same time. So that's what we're doing with this. So good. Hello, good afternoon, everybody. It is Monday again. Usually we do our Monday aftermath, where I just do a live broadcast and kind of cover the stats, what happened in the last week and what you missed and what's coming up. But we're going to do something a little different today, something unique. What we're covering today is going to be more about credit. We're just going to focus on credit. And I have a special guest with me in the studio. Well, I'm also doing all the producing on the live stuff. So forgive me as I'm slightly distracted here. But I've got with me Chris Coulter here in the studio. And so, Chris, I appreciate you being here and kind of doing, a multi-look at credit with what we've got going. So first, I want to say welcome.
Thanks for having me, Jason. I'm glad to be here. I love talking about credit. Talk about it all day, every day. So,
well, it's kind of what
we can try to make sense of it.
Well, that's really the
podcast.
That's really the idea of this, is to want to talk about it. So if you're a first-time home buyer, then this is probably something that you're going to want to think about, because credit's going to be a big deal to you. If you are a move-up buyer and improving your credit, because when you're a first-time home buyer, your credit was good enough to get in, but not great, that might be something. And in general, if you're somebody who's just concerned about your credit score and you are reticent to buy real estate or anything because the pulling of your credit makes your score go down and you lose sleep over that, we're going to cover that too. So we're going to cover about establishing, improving, repairing, and then even explaining the difference, because I don't know if you know this, but there are different kinds of FICO scores. Now, the scores are all the same numbers, meaning they're all ranged between what is it, 200 and 800?
400 and 800.
400 and 800 is typically in there. And I think like 850 is a perfect score. Like if you have that, you're done. So those are the ranges on all the different kinds, but there's different classifications used for different purposes. So let's go ahead and just start with a credit overview of what credit is. So let's kind of cover of the first-time home buyer, like establishing credit, right? That's one of the big things. So
sure.
What is your thought on establishing credit? Like, well, what do you counsel people to do?
Yeah, it's not hard to establish credit if you have no credit. I mean, my thought is, as a young person, if you are, above the age of 18, you can of course obtain your own credit card.
Right.
If you can, where you bank, typically if it's a Wells Fargo or a large bank like that, a lot of times they'll offer to issue you a credit card if you have a checking account with them. So I would accept that offer, and then I would use the card sparingly. So a lot of times there are credit card offers that will allow you to get approved without a cosigner or without anybody adding you to an account. But another easy way to do that would be to take a parent or relative that has a card and add you as an authorized user. And in doing so, it does not make the person that's being added as the authorized user an obligatory to the credit card. They don't have to pay it. They're not responsible for it financially at all. They're able to use the card only. So, a lot of times people in work environments will make employees authorized users if they trust them. If it maybe is a gas card that they have to use on deliveries or something like that, then they'll allow them to be an authorized user. That card will show up on your credit report, but you have no obligation to actually pay that bill.
Okay.
And so you can do that with a child as well.
Right.
And that will generate, after maybe 30 days, 60 days, a short period of time, it'll generate a credit score.
We'll come back to that one, because that's going to be one of the good hacks of what you can do as a first-time home buyer. But so is there a difference in between going to your local bank, like you talked about, like a Wells Fargo, one of the large institutional banks, and or maybe even like a Barclays, where you're getting some kind of offer of credit, versus establishing credit through a department store card? Does it show the same? Is it treated differently?
It's not. I mean, it's treated as a trade line, as a revolving trade line, but no, they don't. One doesn't carry any more weight than the other. There are lines of credit that are weighted more heavily in a negative direction than maybe a Barclays card or a Wells Fargo card. But that would be like
what?
Your finance companies, Republic Finance, American General Finance, payday loans, payday lenders. You can tell those are notable to the credit bureaus. They recognize those as a particular kind of of creditor.
Okay.
And so those
So
are looked on less favorably.
that's what I wanted to make
Yes.
sure we established. So if you got a bunch of those, it could hurt you.
Well, if you have a bunch of them, the accumulation of a bunch of payday loans like that can definitely hurt you, even if you pay them on time. If you have one, it's probably not going to have a great impact as long as you're paying it on time and paying it as agreed. But if you accumulate a lot of those, then yes, it will lower your score.
Okay, so why is that? Is it because of the nature of them being high interest loans and that they would do that, or is it?
Yeah, they recognize that they haven't been able to get approved for a bank credit card or things like that. So then they've gone down to the payday lender to get approved. And yes,
Perfect.
those rates are definitely 18, 19. I mean, a lot of the credit card rates are 18, 19%. These rates can be 29%, 35%. On these payday loans. So
I thought anything over 29 ended up being against the law from usury.
There's a huge difference. There's a huge gap between the rates on the department store cards.
Gotcha. Yeah,
and that's that they recognize that. So they figure if that's your habit and you're doing that multiple times and you're trying to get your hands on credit,
you might be running
it's a
thin.
riskier situation. And a lot of times when they will go back and look at default rates when they're setting these guidelines, they'll do some forensic underwriting and go back and look at the characteristics of some of the folks that did default. And a lot of times they had loans like that on the credit score. So the existence of a lot of loans like that I don't know that it's led to defaults, but they're present when a default exists. So it's considered a precursor.
Got it. So that's one of those things. They're basically just using statistics. They're going, okay, we're taking a batch of loans that went bad where we lost money, and we're looking for commonalities that may or may not be indicators, but factors we should use in rating credit risky or credit worthiness.
Right. That's exactly right.
All right. So
so you go from taking out a credit card at a bank to maxing out that credit card at the bank, to taking out another credit card to maxing that credit card out. Then you go and get a payday loan or one of these finance company type of loans, and you max that out. And then you go 30 days late on one of the cards because you've run out of the ability to obtain cash. So when that 30-day late hits, that's when the house starts to crumble and the credit score really starts to drop. But there's a pattern, and they've developed that pattern, and those finance companies do play a role in the pattern.
Got it. Okay, so the next thing I want to kind of briefly talk about is the FICO score is not the credit, right? So the credit, my understanding is credit report is basically just a report. And there's 3 different major bureaus, maybe more, but 3 that are commonly recognized, which is going to be Equifax, TransUnion, and Experian. So those are the 3 ones. And trade lines are sometimes reported to 2, if not 3 of those, maybe in some cases 1, just depends on what they are.
Right.
And so that data gets put on there as, hey, here's the credit line, here's the history on it, here's the payment history on it, here's the balances on it, here's the credit line increases on it. So it's just data.
It's just a bunch of data.
It's just a bunch of data.
Yes.
At no point does it render a judgment. So where FICO comes in is they now partner with these companies that have the data, and they take this data and they're looking at, based on their history, their patterns, their research, and whatever, and the purpose behind it, they're going to go in and render a score on this.
That's right.
And so this becomes the part of where it's extremely confusing. And if you're watching this broadcast and or even after the recording is out, you might go, well, why do I care? Well, there's some disconnection between what you see on your consumer apps and then what it takes to buy a house, right? These things are not equal. And if you have a FICO score, your score should be your score, but it's not. And there's a good reason for that. So I kind of want to lay the groundwork for that real quick. So I'm actually going to bring up my screen and I'm going to show you guys a little bit of something that might be new to you. Okay, so here on the screen, what you'll be able to see here is there are different types of each scoring model, right? So FICO is a model, and they have multiple different models. They have a FICO 2, a FICO 4, and a FICO 5. And it says, for example, these are being used by both mortgage company and auto lenders to determine borrowers' credit worthiness. So they're taking that same data that we just talked about, they're compiling it into these 3 different models that they just mentioned, which all weight the stuff differently and in different ways to discuss credit worthiness. Currently, the most common FICO score is a FICO 8. This version can be used for auto lending, but as well as also used for personal loans and credit card decisions. And of course, we talked about the 3 major bureaus and your scores. This one shows FICO ratings down in the 300s to 579 is very poor. Fair which is interesting. They call between 580 and 669. Now, I will say that in that fair range, FHA does report that they can, even though a lot of banks won't touch it, do credit scores into the 580s.
Sure.
And realistically, the barrier we try to get people to is 640 to 660 before they, so they're not paying out the nose on risky whiz, which falls in the fair category. 670 to 739 is considered good. 740 to 799 they consider very good, and 800 to 850 is exceptional credit. And that's pretty much how they're doing the ratings with this. So
on the FICO 8.
Well, this is just in general. It just says FICO scores, but it very well could be. It's FICO classifies its scores as exceptional, very good, poor, and the table which shows the ranges. So I think that range is what they're calling it across it. But the reason that the numbers aren't the same, because otherwise all they would have is you'd have one FICO score, and then one would call one good, and the other one would call it poor. Right? If they were going to weight it differently. But instead, what they did is they created a very linear, exceptional, very good, good, fair, and very poor numbers that are linear across all the FICO scores.
Okay.
And now what they've done with that is they've said, okay, what we're going to do is the input of data, we're going to develop different models for different reasons. And that reason is probably one of the key ones that that I really want the viewers to know. And that is the difference between the FICO 8, we'll call the 8 and the 4. Right? Because those are the most common ones. So a 4 is what you guys are probably going to pull in a tri-merge.
That's right.
Right? And in the 4, one of the biggest things that I hear people say all the time, and tell me if you've heard this, well, I don't want you to pull my credit, Chris, because I'm afraid it's going to affect my score and I'm not ready to buy. But there's so much they need to know to get ready that they can't get to unless you pull their score.
That's right.
Right. So you hear that a bunch.
I do. I hear that a lot. The cost of the information that you get from the credit report and understanding what mortgage credit score we're viewing on the lender side, on the mortgage company side, is worth the cost of the inquiry.
That's what I think.
So an inquiry is certainly one factor that impacts a credit score. I wouldn't even call it the major factor that impacts a credit score. You could have an inquiry, and if you have an inquiry on your credit report, even if it's a hard inquiry, where you're pulling credit from all 3 credit bureaus and it's a mortgage credit report, it's not one inquiry on otherwise good credit, or even average credit, even less than average credit is not going to drop the score very much. However, what they do start to look at is an excessive number of inquiries can drop the score. Now, an excessive number of inquiries, might be if you were shopping for a car and you went to 3 dealerships and every dealership pulled your credit 3 times because they had 3 different banks looking at your particular scenario.
Okay.
So you ended up with 9 inquiries by the end of the day shopping for a car. I've seen that happen. That's an excessive number of inquiries in one day, and that definitely can impact the score. But the way they view mortgage credit scores, or FICO 8, FICO 4,
FICO 4,
okay, is that, if you do a mortgage inquiry with me at Southeast Mortgage, and then you go do a mortgage inquiry somewhere else, that's going to be one inquiry as long as those inquiries are done within a 30-day period. Okay. So you could do multiple mortgage companies and you're shopping for shopping for a mortgage, right?
So let's just call it, we'll say we're going to do Wells Fargo, Bank of America, and Southeast, right?
Okay.
So we pull those 3 in the first 30 days. And before we hit day 31, how many inquiries does it show?
One inquiry.
Got it.
That's
all right. So that's one inquiry. And I've heard,
and the reason like we were talking about earlier, the reason that is because it stands to make sense that if you've pulled your credit at 3 different mortgage companies, you haven't bought 3 different houses in a 30-day period.
Right.
I guess it could happen, but well, it's not
likely because you have to go through so much more than just pull your credit. Like a car decision is made there on the spot, right?
Right. Whereas
if they say yes, they do the paperwork, they shop it to the bank,
you've got
you're
that
done.
Piece of credit at the end of the day.
But a house has to go through, like if you pull the credit and say we're worthy. Now, granted, we're going to bar the fact that Southeast Mortgage can do things like leap a building in a single bound in 8 days, right? We're leaving the 8-day conversation off. level playing field, right? All right. So no Tom Brady's in the mix here, just
Right.
level playing field. 30 days to get through this process. A lot can happen in 30 days that affects things up and down that they have to go through the process to get it done, which is why it makes sense to treat it as a single inquiry. In fact, I'd actually heard some sources that say in the first 30 days, they treat it as 0 inquiries. And then after that, for 45 days, they treat it as 1.
Okay.
But again, like, some of that data changes, but it's to the same point. The whole idea behind it is to say, as a lender, I should say, as a bank lending on a mortgage, I want the data, the model to read differently if they went out and got 3 department store inquiries, one for Rooms to Go, one for Sears, one for Best Buy, and one for God knows what, right? Amazon. So you got those 4 different ones versus you looked at 3 banks. The problem was they were punishing consumers for shopping mortgages. So then you were literally stuck with the first person you talked to because you were afraid of your credit, which could result in predatory lending and a shakedown, right? And so in order to avoid the shakedown, they basically created the different models that says, okay, same data, but we want these inquiries weighted differently for us.
Interpreted differently.
Right. And so this really...
Because the score is being used for a different reason. It's being used to open a credit card, to buy a car, to buy something that you can obtain that day very quickly, whereas the mortgage credit score obviously is used for a much more thorough underwriting process, and so therefore the factors that go in are going to be more nuanced.
Right. And this is something that people really need to think about when they're opening credit lines, and why it's a different thing, to consider.
And this is why the score that the FICO 8 is more available to consumers. I mean, It might be the score that you see on your bank statement when you get your monthly Wells Fargo statement, or your credit card statement from Discover will have a score on it. That's going to be a FICO 8 score, not a FICO 4 score.
Well, and let's discuss that, because this is to anybody out there you're panicked. You're the one that does not want to release your credit information to somebody like Chris because you're afraid of this. So I'm going to give you a real life scenario that happened actually with Chris as the lender and my dad as the customer on this. Is he watches those FICO scores on his thing, and during the process there is the soft inquiries and hard inquiries. One had to be pulled just to get something done so we could get to a closing, and this was years and years ago. And as a result, what ended up happening was it showed a hard inquiry on the app that my dad had, which made him believe that the credit, he just got his credit score dropped on the app. And he's like, why are we doing this when we know I'm already approved for the loan? And the point is they're actually 2 different modeling numbers. The model over here that would have affected his interest rate didn't actually change.
Yeah.
Because it's the same bank that's already inquired that's basically doing an update to the credit report to make sure there's no new things that came up.
Right.
And so those can affect those differently. Now, could that affect his Rooms to Go purchase if he was going to look? Well, if he was on the borderline on his credit, maybe. In their case, they're so high up there that even on a FICO 8, if you took a 60-point drop, you're still in the 700s. Rooms to Go is going to give you a credit card.
Yeah.
So
and that's important for your listeners to understand too, is the credit score. Because I get the question we get a lot of times is, well, I'll pull a customer's credit report and say, okay, your credit score, your middle credit score, because when we underwrite a mortgage, we take 3 scores and we drop the high, we drop the low, we use the middle. Okay. And my middle score might be a 760.
Okay.
But the customer tells me that, well, on my app, it shows that it's an 809. And, a couple of things to understand on the credit, your credit score.
We all want the 809.
Everybody wants the 809. No doubt. I want you to have the 809. I want to pull it and it be an 809, but your credit score is not a static number, is my point.
Right.
It's always changing because the way you use credit is always changing. You might charge up a tank of gas. You might buy a stereo. You might buy something on your Amazon card that was a significant purchase that causes your balance to increase as it relates to your credit limit.
All right. I need to stop you there for a second and say, only people your generation and mine and higher say buys stereos.
But stereos. You mean the turntable and the equalizer that comes in the rack?
It's now vintage and cool.
Oh,
so that's the thing. So they're probably going to buy an iPhone.
That's true.
Or an Apple Watch,
an iPad, or a MacBook. Or something.
Like that. Yeah.
Something.
But To your point, right?
Yeah, but you charge a vacation. You go on a cruise,
Right.
and you
Okay.
pop that on a credit card.
Which we always do, because then you get points.
You get
for
points. Well, that, if at the time that I pull your credit, that balance is on there, your score might suffer a few points. Doesn't mean that the underwriting of the loan or the outcome of the underwriting would be different. It might still be good enough to qualify you for a mortgage just fine.
Okay.
But as you open credit, use credit, if you see your score the day you pull it.
Right.
Okay. But every other day,
it's moving.
It's constantly moving.
Right. So the score is important because you want it to be within a range, but the up and down of a little bit during the purchase process, which is fairly minimal, isn't actually going to have an impact on their interest rate necessarily.
Not necessarily.
The only time it really is critical is if they were on the borderline of qualifying, right? So if they're sitting, just at the helm of, let's say, a 620 credit score, and we're already having to pay extra points because everything's just so tight.
Yes.
And then something happens that pulls it down.
Use the card. Don't open new credit. Be very, very careful if you're right on that border.
Right. So, but if you're up and you're at a later stage of life and you've got a lot of credit cards and no balance on those, you've got good credit, whatever, that room is going to move on those, right?
For sure.
Okay, so that's good. Now let's that being, the score being an important thing, but not the end of the world thing.
Nope.
What I'd like to talk about now is in doing credit and establishing credit, which we already talked about in this broadcast of how you can establish credit, is how to utilize the credit. Right. So if you've got, I want you to talk about percentages.
Okay.
Right. Because if you get credit lines, right, before we get into the mortgage conversation, what is the percentage that you can put on a card? Because some people think of it as amounts. Like if I have a $10,000 credit card and I put $3,500 on that credit card as a balance, and somebody has a $500 card and they only have $400 on there, they think theirs is going to look better because they only owe $400 and I owe $3,500. But that is not how that algorithm works.
That's correct.
So go ahead and talk about what that looks like.
Yeah, sure. So that is a big factor in the score moving up and down, is the percentage of available credit that's in use. Okay. So yes, the amounts don't matter. It could be $100,000 Amex credit line that you got $35,000 charged on, or it could be a $1,000 limit. You got $350 charged on it. That's the same score.
Got it.
That's the same impact. And it is about 33%. That's the ideal percentage of available credit that you want to limit yourself to.
Okay. So in other words, whatever your limit is, you want to stay under the 33 to have the best impact on your credit.
Have the best impact on the score.
Okay.
Yes.
Right. So, and let me ask this question. Is 0 better than
no, actually a little activity on the card is healthy. Lot of, and you get into a lot of that depends on the depth of your credit. What, how long have some of these accounts been open? For example, these percentages that we're talking about are going to be more impactful to a younger person who's only had a credit card for 6 months or a year, and maybe only has 2 credit cards. And, of the 2 credit cards that he has, one of them's charged up. That's going to impact it more than, say, somebody who's had 3 mortgages, a couple of car payments that they paid off, and now they've got 3 or 4 credit cards. None of them have balances, but they maxed one of the cards out because they went on a cruise. Okay, that's not going to impact the guy who's had 20 years worth of good payment history,
right?
But it is going to impact the young person who has 6 months worth of payment history.
Got it.
Because what the theory behind it is that you've got this available credit to you. If you are only charging 33% of the credit, then you're exercising restraint in your finances. Okay, if you take out and you open up a credit card on Monday and on Tuesday, and you open it up with $1,000 limit, and on Tuesday it's got $1,000 balance, your score is going to drop. Okay, because that
is this the marshmallow thing?
Yeah, immediately. It's, what do you mean?
Yeah, that thing they with the kids where you put the marshmallow out and it's like, if you wait, I'll give you 2 marshmallows.
That's exactly what
and then, but if you don't, you eat it now. That's what you get it. And
that's all you get.
And the one kid didn't even let him finish. He's like, oh,
yep.
What are we talking about?
That's exactly right.
Yeah. Yes. So the exercising restraint will actually, so they'll view that differently. So that's some of the nuances in there. I do not want to revisit the conversation that we had started a little bit earlier about ways of establishing credit. And I call this the hack, right? So if you are a first-time home buyer, especially a young person, and we'll use the example of my son, because, he's a great example in this. And you're like, they're just coming of the age of 18 years old, want to buy a house. Mom and dad will do the co-signing thing, which, by the way, co-signing only helps with the debt to income ratio, meaning if they have enough money to cover the debt load, it doesn't actually help with the credit score issue. The credit score issue. So a young person, getting him in as an authorized co-signer on one of my long established cards when he had basically no credit, within a 30-day time frame, gave, in Sam's case, a 750 credit score. Right.
We're good.
Right. And so all of a sudden you get a kid that you're doing a loan for is 18 in like 3 months. Right.
Right.
So just 3 months past his 18th birthday, he applies with Chris. Chris gets him a 750 credit. He has a 750 credit score because of this hack that we're able to do. And they put him through underwriting and they give him prime rates because,
it looks like he's got established credit that's been open as long as the card's been open, which in your case was more than 10 years,
Yeah.
At which case it would have had him with a credit card at 8 years old. So, it wasn't his card, but it gave him that established credit that generated a high score.
Well, and that's the reason I'm calling it a hack, right?
Yeah,
because,
it is a hack.
because clearly that's a hack, because no 8-year-old has a credit card. And if they do, well, we see how that
And you
worked
don't
out
even
for Macaulay Culkin.
You don't even have to give him a card. You don't
Right.
just add them. You got to call the card company, tell them the social security number, the name of the person that you're adding.
Yep.
And within a 30-day period, it'll show up on their credit report.
Yeah. I
That's
want to point out, I didn't give him the card.
Don't give him the card. You don't need to give him
He's
the
a
card.
trustworthy kid,
Yeah,
but
people think you say add him as an authorized user. Well, I'm not going to give him one of my credit cards. Well, no, I'm not asking you to do that. Don't even give him a card. Don't let him sign anything.
Right.
Just allow it to generate the score. Then he can go get his own card without you.
Which he did.
Right.
And
And
so,
a mortgage.
right. So then he establishes it, and then you got to get past the debt to income ratio and all that other stuff. So different hurdles. But now, in fact, we actually have a qualified buyer at the age of 18 years old, which is a great, great hack for you to be able to look at. So now let's go to the topic. Now we've talked about hacking it and establishing credit and building on the front end. I want to talk about repairing, right? So you get, life happens, right? In the market crash, we saw short sales everywhere. We saw all kinds of stuff. And now people had to find a way to restore themselves back. So what happens if somebody comes to you and they feel, and I'm going to emphasize the word feel, like they have bad credit, which oftentimes isn't true. It's a feeling.
Right.
But if they feel like they have bad credit, you go and pull that. Tell me how you're able to provide such clear paths for them of a to-do list to get their credit where they need it to be.
Sure. So basically, first of all, what I'll say is, a lot of times there is a lot of anxiety in consumers around what their score is, especially when they think it may be less good than they want it to be.
Right.
And that if they haven't looked at it in a while, they haven't actually laid eyes on the problem, then in their mind, it's going to be bigger than maybe it actually is. Because I find that when people come and say, they don't even want to give it a shot. They don't even want to try. They don't even want to look at it because they think there's no hope. Then we pull the credit score and it's not so bad. It's like a 601 and something that we can repair in a matter of maybe 90 days. That is the case, I think, more than half the time. Okay. But, let's say that we get someone, we don't want to just ignore the person who has destroyed the credit because life happens.
Right. But is that a little bit of like the ones that have a sense of a conscience to it? They're just like, well, it's really, really bad in here. I really don't want you to come in. My house is a mess. And you walk in and like, this is not really all that bad. Yeah. And then you've got the other guy who's like, hey, come on in, check it out, man. I upgraded that thing over there in 1984. And you're walking into a house that should be condemned.
Right.
And they're like, but I fixed that counter. I'm like, but it's broken.
But it's broken.
And they're like, yeah, but I fixed it in 1984. And I'm like, but it's broken today. I can't sell it if it's broken
today.
Yeah. And
carpet.
Yeah. And so those are the ones that be like, oh, my credit. Yeah. Yes. No, it should be fine.
Should be okay.
Should be fine.
I worry about those more than the people that actually come in thinking they have problems.
380, right? 380 is
exactly.
a real good one. Yeah. We appreciate that.
Exactly. So they should approach particularly me as a lender without fear of judgment, because that's not what we're pulling the credit for. I mean, certainly we're making judgments, but we're not judging necessarily the character of the person or how they got there. The point is that we want to get them in the best position possible to buy a house as quickly as they can. Doesn't matter what's happened in the past, other than how that helps us learn from those events. So I mean, the first thing to do obviously is to lay eyes on the problem.
Right.
That's just pulling the credit. It's not very hard. Takes 5 minutes. I just need a minimal amount of information from the person,
okay,
and their authorization, get it pulled, and then we're reviewing. Some of the, now there's so many directions that we could go here. I mean, we
Right.
could go in a lot of depth on, repairing credit.
So
but
let's go
here's-
with some hypotheticals. I don't want to talk to over people's heads where they find
No.
it boring or whatever. So like I want to
Let's talk
yeah,
about tools.
the tools. So
Okay.
like we bring I'm gonna use myself as an example so that we're not, talking about anybody's personal credit stuff without anybody's permission on this. So and mine's gonna be completely hypothetical. And so here's what I'm going to say. Thanks for the shout out, Dr. Fahrenheit. We appreciate you watching. What I would say is if I came to you, hypothetically speaking, and I had damaged credit,
Right.
the very first thing you're going to do is you're going to pull my credit to see what we're talking about. And as soon as we've established what you're talking about, now you're going to go in and pull up a tool that we can talk about. I'll let you talk about it more in depth, that actually gives some credit modeling things that says, okay, based on this report, what will time do? Right. And there's nothing we can do but sit for time. And then we come back and go, okay, it's not about time now. There are action steps you can do. For example, if I have a small credit card with a high balance on it and it's not that much money, paying that down quicker will cause the score to jump pretty good.
Absolutely.
If there is some delinquencies, but there's not a whole long history of delinquencies, correcting those delinquencies might be the way to go. If there are things that have been charged off for a long time, not touching those things could be the would be better, right? Because touching them makes them fresh and then it hurts you more.
That's right.
On this. And so just use that. You use my name as a fictitious example, insert in whatever facts you want and talk about the tool that you use to help really make that something.
So it's a credit score simulator is the tool, but I'm going to back up for just a second and say, once we review the data, I mean, the first thing we're going to do is I'm going to ask some questions.
Okay.
And and I'm not going to model the questions here, but I mean, I'm just going to ask a bunch of questions about making sure that the data that I'm seeing on the report is the data that they recognize. Okay. Because a lot of times you'll say, okay, did you know you had a charged off account from Best Buy? No, I've never had a Best Buy card. Okay, well, now we've got to investigate that. So that's the first thing we're going to do is we're going to make sure we got accurate data on the report. Okay, if your name
how often do you see that happen?
A lot. So if your name is Jim Smith, and it's not uncommon, or even if it's a Jim Smith and you're Jim Smith the second, you may have some of your dad's credit bleeding over into your credit report. So I always want to make sure that we've got the right information and that you recognize the information that's contained in factoring the score. And if it's not, then I'm going to send you first on a fact-finding mission to explore what these accounts are. Because, I mean, there's errors. These are reporting agencies, and credit reporting agencies are passive. They receive data. They don't proactively go out and seek it. They only report what somebody else reports to them.
Right.
Okay, so we got to make sure that what's being reported is accurate.
Okay,
and
so we're going to go through and say, is this you?
And then we've got phone numbers of all the creditors that are reporting anything on your credit report, and you may have to make some phone calls to suss out what's right and what's not. That's the first thing.
So let's assume that the mess we find is my mess.
Okay. Yes. So then we're going to take a credit score simulator, and of course, it's going to depend on what the mess is. And the first thing we're going to do is we're going to look for credit card balances.
Okay.
Typically, that's the first thing I'm going to look at because that's going to really move the needle on the score initially. I'm going to look probably for credit card balances that are lower amounts.
Okay.
So if in the example that we used earlier, $35,000 on a $100,000 Amex card and $350 on a $100,000 Amex card, I'm going to suggest you pay off $350. Right. Obviously, that's going to be easier to do. It may not be the answer, but it's going to be one step towards. It's going to pop your score a couple of points.
Or let's even take that one step further. Let's just say you have 35,000 on one. And then you have another one and it's not equal. It's not 350. It's 850.
Okay.
Well, that 850 is 85% of it's available. So that's actually having a bigger negative impact on your score. To pay that down will probably have more of an impact than if it was only at 350 paying it down.
Yeah.
Right?
I mean, they look at that. They also look at the total amount of available credit. They'll accumulate the balances too. So it still is not great. That 35,000 is still going to have an impact. I mean, it's definitely still going to have an impact, but you're going to get a little bit of a jump from paying off the little one. Yes.
Okay.
Yes. And so we're going to look at we're going to look at that, and we're going to look at, whether there are any collection accounts and charge-offs.
Okay.
We're going to address those if there's 30-day late payments, and whether there's a pattern of 30-day late payments or whether there are isolated 30-day late payments.
Okay.
Okay. And so really the first thing that you can do, and so from that, we can input data into the scoring model, and it'll say, okay, we started with a 540 credit score. If we pay off this card, this card, this card, the score pops up to 590. Still not ideally where we want to be. We really like that to be to a 620. Then we can age the credit report. We can say, okay, 3 months down the road, assuming on-time payments of all the other credit cards, the things that we've done here will result in, it's a 590 immediately when you make those changes. 90 days later, it's a 610.
Okay.
So you can
So
time
now
it
we're
out like that.
now we're in the realm of we could possibly do something.
Now we're getting close. Absolutely. Okay. And so that's just an example. We can do all kinds of different modeling and changes and hypotheticals on that system.
Okay.
But we're also going to have an overall conversation about the way the credit's been used, what there is, what's factoring into that, and then why that is, impacting the score the way it is.
Right.
Like patterns, like, 130-day late on something is not going to kill you. If you were 30 days late on this one, and then 6 months ago you were 30 days late on one, and then another 3 months before you were 30 days late on something else, it's going to all accumulate and equate to a pattern. And those patterns, those negative patterns, will drop scores.
Got it.
So sometimes time is what cures it, and you have to change your habits and your patterns.
Got it.
And even if that means just ceasing using the credit and just continually making the payments on time.
Got it.
Eventually that will repair the credit if you do nothing else.
Got it. So the tool is very cool. You'll be able to go in it and play with it and say, if I do X, Y, and Z,
yes,
whether that be stop paying, start using, whatever it is, you can write the prescription for it, and it'll say, if these are done, it should result in this credit score. And based on our experiences, that model's pretty accurate. In hitting it. Although, it doesn't control it, but it is pretty accurate.
No, because there's always, the score model assumes that all other factors stay the same.
Right.
So you haven't opened any new credit. Nothing else has charged off. You don't pay anything else late. Any other information that might be fed into the credit report, between the time that we pull it and write that prescription, could affect the accuracy of what we said on that day. Because other things transpired. You opened new credit. You did some other things that weren't prescribed.
Got it. Okay, so now we get to the end of the road. We've talked about, just as a recap in here, how to establish credit. We've talked about the FICO scores, the difference between a FICO 4 and a FICO 8, really, because that's what we were focusing on in there. We've talked about improving credit, some of the tweaks like the utilization of lines and how to manipulate those. We even talked about hacks where you can take a kid like my son, throw him on a credit card at the age of 8. Actually, he was just 17 and change. He turned 18 years old, has a 750 credit score, and buys a house. And then he tries to go out and buy a motorcycle, and the guy wouldn't give him one.
Really?
Oh, they looked at him. They say,
I don't think I knew that.
There's like, he's like, this is the weirdest credit report I've ever seen. You got a high score, you make this much money, but you have a mortgage. Like, how am I supposed to justify this motorcycle? And he's like, well, I got roommates that pay the bills, but it was a new house. So he didn't have, a tax return to show it,
right.
And so they're like, this is the strangest thing I've ever seen. So you get those hacks in there. Now we come back to at the very end of it. And this comes down to, what advice do we want to give to the consumer, right? A lot of people want to wait till their stuff is good before they talk to somebody, because they think you or me as the banker are going to look at them and go, well, no, we're not going to give you a loan. Go away, as if it's some type of judgment.
Right.
They don't see it as, no, we want to help you make the report read the right way so that you can. It's different, right? It's like, I don't want to apply at an Ivy League school and have them be like, oh, not you, snooty, turn away and walk away.
Right.
And so they want to wait till they're polished to come in, but it's not like that. Come into, getting the credit pulled now really actually will help their situation.
Maybe.
Because you can plan ahead. So my advice has always been, talk to me as far in advance as you possibly can, even if you're not ready to make a decision today, so we can give you the tools to go there. What is the advice you give to people on when they should have this dialogue with you to set themselves up for success?
Early in the process, as early as possible. My job as a loan officer is to help you pay the least amount of interest over your house buying career as possible. And part of that is putting you in the best position to qualify, the best position for rates and everything else. So even if you have a mediocre credit score, you should go ahead and take a look, because we might can turn a mediocre credit score to an excellent credit score in a short amount of time, which is going to make a difference in your monthly payment, in your qualifying, and just, like I said, the amount of interest that you'll pay over time.
Right.
So definitely it's to take and if you're on the other end where you think your credit's a problem, the sooner you lay your eyes on the problem, the sooner you can get to a solution. And that solution is never as far away as people think it is in their mind.
Right. It's not as bad. A lot of times, I mean, I can't tell you how many times we've had this conversation and somebody's like, I can't qualify. And they look and they qualify right now.
Yeah, right now.
Right. Like, I mean, it's not even a simple fix. There is no fix. Sure, we can even give you some things that hopefully we can get the score higher, but it's almost unnecessary because you're in a window of score where the rate's going to be the same.
If you're making decisions on buying a house, on probably the biggest purchase that you're ever going to make, then you should be making the decisions based on the most accurate information that you possibly can. So if you're just out there running payments on houses on Zillow or something else, you're making a lot of assumptions that you shouldn't be making in terms of qualifying, in terms of what that monthly payment might be. And you're either excluding yourself from the housing market, or you're over promising what you think you can do,
right?
Based on inaccurate information. So I think if you're serious about getting into the market and you're serious about getting into the market within the next year, 2 years, I don't think that's too early. We don't mind. We don't charge anything to pull your credit and to have this consultation. We hope that you use our services when it comes time to actually close the loan, and that's why we do that. But a year in advance, I mean, I'm talking to people constantly that are like, we want to buy a house, this year, or we want to buy a house next year and we just want to prepare. We need to know how much money that we need to save in order to be able to accomplish this. That's the other outside of the credit. That's another. So it's not too early to start planning. It's not going to cost. And that's the thing, is you're talking to somebody who's got, 28 years of experience in the business, and is going to help you make an accurate plan. So I can't overstate enough. Early in the process is the best time.
Now he's like, now. All right. Well, so there you have it. That's kind of the 10,000 foot view, and even getting down to the weeds a little bit on what credit looks like. We could go a whole lot deeper and a whole lot nerdier on a lot of this stuff, but we wanted it to be a conversation to kind of walk you through what we've seen. How many times we've had conversations with people that were like, I can't buy. It turns out they could, and they were about to sign a lease for more money than it was costing them to buy. How to help fix credit and get it back to a position where they're either saving money or they go from not qualifying to qualifying. Credit hacks for young people that decide to start out their life owning a property versus renting on the college campus. All of these things all go back to this single piece of advice. Start today on getting the answers to the questions for your profile. I don't care if you don't buy for 3 to 4 years, right? I'm all about education. It's why I sit and make all this content, is because people ask me questions. My whole life is answering questions. Like, I wake up in the morning, everybody's like, hey, where's the butter? Hey, how do we solve world hunger? Like, I feel like that's, I'm getting asked questions like this all the time. I'm like, feed people. That seems to make sense. The reality is, with a credit report, is now is the best day to start the journey to figuring out what you need to know. And then the rest of it can work out. And by the way, that doesn't mean you're committed to be like us and have home ownership. You might want to be a vagabond. You might want to travel. You can still do that, but you got a bead on what it looks like for when you change your mind. So I want to say thanks to Chris for spending time here in the studio with us today. Thanks to you, those of you that got on the live broadcast with us. This will be archived and recorded and posted on YouTube. You'll also be able to see it in Facebook and Instagram in the history stuff there. And if you have questions on credit, please feel free to reach out to us. I'm going to put Chris's number back up on the screen that Aaron had posted in there, so you can see that on screen. You should be able to see that on screen right now. So if you are interested in getting this free consultation with Chris, then call that number below. You can text it or call it, and we can start this conversation with you. So thanks a lot for being here, Chris. Thanks for being here, man.
Jason, thanks so much for letting me come on.
Yeah, absolutely. And we will talk to you guys soon.